The J.P. Morgan quant team sat in a conference room on the 37th floor of 383 Madison Avenue. The date was June 14, 2022. The meeting had no name, no agenda distributed beforehand, no minutes recorded afterward. That was by design. What they were about to discuss could not be written down because writing it down would mean admitting something their models had no category for. The head of the desk pulled up a single chart on the wall-mounted monitor. It showed the equity curve of a retail trading account held at a brokerage they had acquired 3 years earlier. The account had started with $10,000. 18 months later, it had returned 47%. The win rate was 37%. The position count was 73 trades total. The average holding period was 8 hours. The room went quiet. Someone in the back said it had to be luck. Someone else said run the Monte Carlo simulation again. They had already run it 9 times. Each time the probability of this outcome occurring by chance came back at less than 0.03%. The head of the desk said nothing. He just pointed at the screen and waited. This was not a story about a breakthrough in quantitative finance. It was not about a secret algorithm, a machine learning model, or a proprietary data feed. The bot that produced those returns had exactly one indicator. It had exactly one rule. It had been written by someone who had never taken a single course in finance, statistics, or programming. The builder was a 34-year-old former truck driver who had taught himself Python in a rented room above a tire shop in Bakersfield, California. The gap between what the institution expected and what they found was not a gap in performance. It was a gap in ontology. The institution believed that winning required complexity. The bot in its silent flat line had committed the unforgivable heresy of proving them wrong. If you have ever opened a losing position and felt that cold knot in your stomach, the urge to close it before the loss grows, the fear of being wrong in a market that punishes wrongness faster than any human can process, you know what the quants saw when they looked at this bot. They saw a machine that did not feel that knot. But more than that, they saw a machine that had been designed specifically to wait until the knot had passed. The knot was not a problem to solve. It was a signal to ignore. The meeting lasted 93 minutes. That number will matter later. The institution did not discover the bot by accident. They had been scanning retail accounts for weeks, looking for a pattern they could not explain. A pattern of accounts that consistently returned positive equity in low volatility regimes while remaining flat in high volatility spikes. The anomaly had first appeared in a quarterly risk report buried in the appendix. An analyst had flagged it as a potential data error. The error was not an error. The head of the quant desk gave the order to investigate. The team pulled the account history, the bot logs, the broker's execution data, and the tick-by-tick market feed for every trade the bot had made. They reconstructed the bot's behavior second by second. What they found made no sense within their framework. The bot did nothing for 93 minutes during a liquidity event that had shaken the entire market. It sat flat. No entry, no exit, no signal. The institution's own model had triggered 27 trades during that same window, each one a loss. The bot did not trigger a single one. It had no rule for that event, and because it had no rule, it did nothing. The market moved. The bot waited. The market returned. The bot exited the next day at a small gain. The quants could not model that behavior because their models assumed that trading is a continuous activity. You are either in a position or you are not. You are either winning or you are learning. The bot had a third state. It was not in a position and not out. It was in a condition that existed only in relation to a single variable, the spread between the bid and the ask. When the spread widened beyond 1.2% in the last hour of trading, the bot entered. When the spread returned to the 10-minute moving average, the bot exited. That was the full rule. One variable, one threshold, one condition. The institution's model had 1,153 variables. It was designed to win in any market. It had won in normal markets for years, but the anomaly the bot exploited was not a market condition the quant model had considered. It was a state of nothingness that the model had no category for. The bot had found the gap between what the model knew and what the market actually was. That third state, not in, not out, just watching one variable, is the kind of edge that survives because nobody is looking for it. If you want to find more edges like this, edges the algorithms have no category for, then subscribe. You are the trader the quants do not model. Drop the word spread in the comments if you have ever felt the market give you a quiet signal that the data missed. Think about what that meant for the quants, for the algorithms, for the entire structure of modern quantitative finance. They had spent decades layering complexity on top of complexity, building models that could process terabytes of data per second and execute trades in microseconds. And here was a 34-year-old truck driver who had done the opposite. He had removed complexity until only one question remained. Is the spread wide enough to enter? The answer to that question was not in the data. It was not in the variance-covariance matrix. It was not in the neural network weights or the hidden layers of the deep learning model. The answer was in the structure of the market itself, a structure the institution had never learned to see because they had never learned to wait. The builder's name was not released. The institution never confirmed the investigation publicly, but the internal report, which was eventually obtained through a Freedom of Information request related to a separate regulatory filing, contained a paragraph that the quant team had written in frustration. It read, "We cannot model the behavior of a system that has no model. This account appears to operate based on a single heuristic that is not learnable through standard statistical methods. The heuristic is not derived from data. It is derived from a decision rule that has no dependence on market state." The institution was not surrendering to the bot. They were surrendering to the fact that their framework for understanding markets could not describe the bot's behavior. The bot was not winning in the way they understood winning. It was not losing in the way they understood losing. It existed in a category they had no name for, and that category had produced returns their model could not replicate. Here's where it gets worse. The institution did not ban the account. They did not flag it for market manipulation. They did not even contact the broker. They simply watched it for 6 months because they needed to understand whether the anomaly was repeatable, whether it was a fluke, whether the probability of 0.03% was actually correct. The bot continued to trade. It entered exactly 73 more times. It won 27 of those entries. It returned another 9.2%. The win rate dropped to 35%. The total return increased by another 5 figures. The quants had a choice at this point. They could rewrite their model to include the spread condition. They could build a bot that replicated the heuristic. They could acquire the bot, the builder, or the account. They did none of these things. Because the institution's risk framework had a rule of its own. You cannot deploy a strategy you cannot explain to the partners. And the partners, when briefed on the anomaly, asked exactly one question, the question that broke the investigation. The partner asked, if the bot only wins 37% of the time, how does it return 47% over 18 months? The answer required understanding the size of the winning trades relative to the losing ones. The bot's winners were on average 4.7 times larger than its losers. The institution's model had a rule against asymmetric position sizing because it introduced too much variance for their risk tolerance. The bot had no such rule. It had been built by someone who had never heard of variance. This is the paradox the institution could not solve. Their risk model punished the very behavior that generated the alpha. The bot's edge was not in predicting direction. It was in managing scale. The bot did not know where the market was going. It knew only when the spread was wide enough to enter and when it had narrowed enough to exit. The size of the trade was determined by the width of the spread. That was the second rule. There were only 2. The institution had built a machine designed to eliminate human error. The bot was a machine designed to eliminate institutional error. And institutional error, as the quant team would eventually realize, was the belief that complexity equals competence. The belief that more data means better decisions. The belief that winning requires being right more often than you are wrong. The bot was never right more often than it was wrong. It was wrong 63% of the time, but when it was right enough to more than cover all the losses. That was the secret. Not prediction, not probability, not machine learning. Just a structural asymmetry in how the market rewards patience versus activity. You have felt this. The moment you close a position early because you are afraid the loss will grow, only to watch the market reverse and move past your entry. The feeling is not regret. It is the feeling of a model inside you that prioritizes survival over accuracy. The institution's model had that same pro-survival bias coded into its core. It was designed to cut losses quickly and let winners run. But the design assumed you could tell the difference between a loss and a winner while the trade was still open. The bot could not tell the difference. It had no model of future price. It had only a rule about the present. The institution's model was trapped in the same error as every human trader. It tried to predict the future. The bot did not try to predict the future. It only tried to measure the present. And the present, measured in the width of the spread, was the only thing that mattered. The bot's builder had discovered something that the quants could not learn from their data. He had discovered that the market structure contains a hidden stability that is invisible to anyone looking for patterns in price. The spread is not a pattern, it is a relationship between buyers and sellers. When the spread widens, it means the market is fragmented. When it narrows, it means the market has consolidated. The bot entered when the market was fragmented and exited when it had consolidated. It was not trading the price, it was trading the structure. That is the kind of edge most traders spend years chasing and never find. A structure so simple it looks like nothing, yet so reliable it outruns every quant model. If you want to be part of the small group that sees what the algorithms miss, subscribe now. Because we are about to zoom out and watch the institution try to reverse engineer something it cannot even perceive. And when you see how the quant team misinterpreted the bot's logic, drop the word structure in the comments. I want to know if you have ever stumbled onto something this quietly profitable. And the institution's model, with all its terabytes of data and millions of dollars of compute, could not see the structure because the structure was not in the data. It was in the relationship between the data points, a relationship that required measuring something the institution had never thought to measure, the gap between two prices at a single moment in time. The quant team eventually ran the bot's logic through a backtest across a decade of data. The results were consistent. The heuristic produced positive returns in every year except 2 years where the bot's settings would have needed adjustment. 2 years where the spread never widened beyond the threshold in the final hour. Those years were 2009 and 2010, the years immediately following the financial crisis, when the market structure had changed so dramatically that the old relationships no longer held. The bot's builder had never backtested. He had paper traded for 6 months in a demo account before risking real money. He had adjusted the threshold from 1.5% to 1.2% based on those 6 months of observation. He had made exactly one parameter change in 18 months of trading, one change. And the institution's model made hundreds of changes every week. The gap between the institution's approach and the builder's approach is not a gap in intelligence. It is a gap in humility. The institution believed they could model the market. The builder believed he could only measure it. One approach leads to endless complexity. The other leads to a single rule, repeated with discipline. The institution's quant team had a term for the moment where a bot like this appears in their data. They called it a zero-day event, not because the trade was short-term, but because the probability of the outcome was effectively zero within their model's distribution. A zero-day event does not cause the model to fail. It causes the model to be recalculated. The data point is excluded. The anomaly is removed from training. The model continues to optimize itself for the world it already understands, becoming increasingly blind to the world that actually exists. The bot was not special. It was not a secret algorithm. It was not intelligence in any conventional sense. It was a structure that matched the structure of the market at exactly one point. And the market, in its infinite indifference, rewarded that match. The question the quants could not answer was not how the bot won. The question was what winning even means when your model defines winning as activity. The bot never won. It just never lost. And the difference between those two statements is the difference between Wall Street's approach and yours. The same principle applies to every aspect of your trading. The indicator you use, the bot you run, the rule you follow. You have been taught that success requires optimization, that you need to improve, iterate, refine. The institution believes this because their business model depends on it. They sell complexity. They sell speed. They sell the illusion that more effort equals more reward. The bot's builder never believed that. He believed that the right rule, applied with perfect discipline, would produce results that exceed any amount of optimization. Because optimization only works in a world that is stable, and the market is not stable. It is a structure that shifts unpredictably. The only way to survive in a shifting structure is to have a rule that does not depend on the structure, a rule that measures something constant, like the spread, rather than something variable, like the price. The spread is not constant, but its meaning is. A wide spread always means fragmentation. A narrow spread always means consolidation. The price means nothing in isolation. It only means something relative to the last price, and that relationship is always changing. The spread is a relationship between two prices at the same moment. It is the only measure that does not depend on time, and time, as the quant team learned, is the variable that breaks every model. Every model assumes the future will resemble the past. The bot assumed nothing about the future. It only measured the present. And the present, measured correctly, is always accurate. The institution's model was the most sophisticated in the world. It was built by the best minds in quantitative finance. It had access to data the public could not even imagine existed. And it lost to a machine that asked one question: how wide is the spread? The answer to that question was the only answer that mattered. The identity question at the end of this story is not about the bot. It is not about the institution. It is about you, the person watching this, who has opened positions in the dark, closed them in fear, and wondered why the market seemed to move against every decision. You are not noise. You are the signal the system was not designed to hear. The bot proved that, and the institution, for all its power, could not refute it. They surrendered not to a machine, but to a simple truth they had spent decades avoiding. Winning is not about being right. It is about being structured such that when you are wrong, the damage is contained, and when you are right, the reward is structural. The spread was not the edge. The decision to size the trade based on the spread was the edge. The discipline to wait 93 minutes was the edge. The refusal to add a second indicator was the edge. You have that edge. It is not in your data. It is not in your indicators. It is in the structure of your own attention, your ability to wait when everyone else is trading, your ability to act when everyone else is frozen, your ability to ignore the noise and measure only what matters. The quants could not learn this from their models because their models were built to see the noise. Your edge is invisibility. The things they cannot model are the things you can exploit. This is not a strategy. It is a framework, a way of seeing the market that is native to you and invisible to them. The institution will never recommend it. Their risk framework forbids it. Their partners cannot explain it, but the market rewards it. Not always, not often. But when it does, the reward is structural, and the structure is yours. The bot's builder never wrote a book. He never gave a talk. He never sold a course. He went back to Bakersfield and continued trading his single rule in silence. The institution never contacted him again. They did not need to. They had already learned what they were capable of learning, and what they learned was that their models had a ceiling that was not technical but philosophical. They surrendered because they could not code patience into a machine that was designed to act, and they could not admit that the trader who waited was not less sophisticated but more. You are that trader. You have always been that trader. The system was built to ignore you. Use that. The final meeting room on the 37th floor had one more conversation that never made it into the report. A junior quant, the youngest person in the room, asked a question that no one answered. She asked, if the bot's edge was in waiting, what would happen if everyone started waiting? The head of the desk, staring at the now blank monitor, said nothing. The question was not stupid. It was unanswerable because it attacked the premise of their entire industry. If everyone waited, there would be no liquidity. If everyone measured the spread and only entered when it widened, the spread would never widen because there would be no one creating the fragmentation. The bot's edge existed precisely because most traders believed they had to act. The bot exploited the action of others. It was a parasite on the nervous system of the active trader. And the active trader, as the institution had proven, was themselves. This is the deeper layer the report never captured. The bot did not beat the market. It beat the people in the market. It beat the institution's traders who could not sit still during a liquidity event. It beat the hedge fund algorithms, which were programmed to exploit volatility but could not handle its absence. It beat every participant who believed that trading meant doing something. The bot did the one thing they could not do. It did nothing, and in that nothing, it found everything. That question is still unanswered, but you already know what it means for your own trading. The edge is not in speed or complexity. It is in the discipline to do nothing while everyone else panics. Subscribe to keep uncovering the quiet edges that the institutions refuse to acknowledge. And in the comments, drop a single word: nothing. Prove to yourself that you understand what the bot understood. The junior quant never got an answer. She left the firm 6 months later, according to the records. She did not go to another hedge fund or a proprietary trading desk. She enrolled in a philosophy program at a university no one on the desk had heard of, studying the ethics of attention in automated systems. She had seen something in that meeting that the partners could not see. She had seen that the bot's edge was not a technical insight, it was a moral one. The bot had refused to participate in the destruction of its own attention. The market is not a system of numbers. It is a system of attention. Every tick, every spread, every liquidity event is a record of someone deciding to act or not act. The institution had spent billions measuring the actions, but not the non-actions. The bot measured the non-actions. It entered only when the spread told it that others were acting. It waited when the spread told it that others were waiting too. It was not trading the market, it was trading the attention of the market. And that, more than the 47% return, is what the institution could not model. They could model price, they could model volume, they could model volatility. They could not model the silence of a machine that had decided not to trade. Because silence, in their framework, was not a signal. It was the absence of a signal. But the bot's builder had understood that the absence of a signal was the most powerful signal of all. The report was filed in a regulatory database under a code that indicated it was not for public distribution. The account was flagged for monitoring and never touched again. The builder continued trading until the brokerage was acquired by a larger institution that did not support his bot's API. At that point, he stopped trading. He did not migrate to a new platform. He did not rebuild the bot. He simply stopped. Because the rule was not about trading. The rule was about the relationship between his attention and the market's attention. And when the market changed platforms, the relationship changed. He did not try to adapt. He understood that the edge was in the specific conditions of that platform, that broker, that API. When the conditions disappeared, the edge disappeared. He did not chase it. He walked away. That, more than the 47% return, is the hardest lesson for most traders to learn. The discipline to enter is nothing compared to the discipline to leave and never return. The institution never learned that lesson. They rebuilt their model with a spread condition added to the variable set. The new model performed identically to the old one in normal markets, and slightly worse in fragmentation events. They had tried to clone the behavior but had failed to clone the structure, because the structure was not in the variable, it was in the builder's unwillingness to add a second variable, and that unwillingness could not be coded into a model designed to optimize every parameter it found. The junior quant, now a philosopher, published a paper 5 years later. It was not about finance. It was about the relationship between attention and ethics in autonomous systems. She did not name the institution or the bot, but she referenced a heuristic she called the Bakersfield rule. The rule stated, if the system you are measuring has no model for your behavior, you are not noise. You are a category it cannot contain. The paper was cited exactly 14 times, mostly by other philosophers. No one in finance ever read it, but the rule was correct, and it remains correct for every trader watching this. The institution's models have no category for the person who trades once a month and waits the rest of the time. They have no category for the bot that only enters when a single condition is met. They have no category for the trader who walks away when the platform changes. These behaviors are not noise. They are structural edges that the system, by its own design, cannot see. The bot is gone. The builder is silent. The institution moved on to the next anomaly, but the principle remains. You do not need to be faster. You do not need to be smarter. You do not need to be right more often than you are wrong. You need a rule you trust, a structure that measures the present, and the discipline to do nothing when nothing is the right answer. The spread will widen again. The market will fragment again. And when it does, the question will not be whether you act. It will be whether you have built yourself into a machine that can wait. The answer is not in the data. It never was.